planning? Great.
All right, Tom, go ahead.
All right. So these are the 4 VCs that have been chosen to come up here again, the winners of the bunch, right? Be interesting to sort of figure out kind of why each of the people have ended up on the front here, but I won't try and do that. What I will do is ask questions along with you guys about trends I think that are going on in VC that I think that people in the audience would likely be interested in. Maybe the first topic is IPOs. I was sort of been preaching for the last year, at least longer than that there are no IPOs and the IPO market is closed and that it's not going to happen. And my sense is that things are changing. And I was be interested to hear from whoever wants to talk about whether you think IPOs are going to be an important exit vehicle, because they really haven't been open for the last few years. So, Kurt, you want to talk?
Well, I certainly hope so. I think if you look historically in the good old days, IPOs were the big driver of large returns for venture capital. In Europe, it's even worse than here. It's been dead for quite a while to do good IPOs there, and I'm hopeful that after the US recovers, that'll have a spillover effect into our markets in Europe as well.
So obviously IPOs are great, but there's very few companies that ever get to that stage. I mean, it depends at the seed stage, and I'm sure Brian will have an answer with the angels. I mean, we can be happy with a $100 million exit when we're investing in stuff that has like $4 million valuations, you know? So I think it depends on what stage you're looking at. Obviously great, but we're just happy with companies that have a ton of cash and are happy to pay straight for the companies. I think, you know, it'll be interesting, obviously everyone's talking about Twitter today, to see if their price ends up inflated or if it becomes like a Facebook thing and then gets dropped. And I think if you're a VC and you can't exit on day one, depending on how the price might drop, it might have been better just having your exit, you know, a year ago. So.
You think, should entrepreneurs talk about IPOs to you? Should they say, hey, we're IPOable? I always find that people lose credibility when they actually try to tell me that.
It's so early. I mean, I don't even really want to say. I mean, I want to just see like a base level of financial statement just so I know how people think the business might grow, but I don't even want to see real details. I mean, they should be focused on other things. Again, at the seed stage, when I'm looking in out of our main fund, something like Series B, C, D, yeah, I want to see like a plan and how they're going to exit, and that's more serious. But the seed stage, no, don't want to hear it.
Thoughts on exits and IPOs?
Well, specifically IPOs, years, 8, 10 years. Twitter, it was a 8-year overnight success, right? That's the way I would describe it. The nature of IPOs are fine in a broad marketplace for companies that require large sums of cash to continue to grow. What's the average amount of money that's been raised by a company that's gone IPO? $500 million? Series C, D, E, F, G, right? So they're a natural evolution of a big corporation that requires the kinds of financing that a consumer broad-based brand would require. They're just part of a natural evolution of an ecosystem of growing companies. To the investors, they're super lucky, but you know, they're the unicorns that everybody talks about. As I think I said to you before, the chances of finding an investment in that space are zero, literally zero.
Well, not completely zero, just very small, Brian, right?
Approaching zero, 0.07%.
I mean, I'll just say that the beauty about thinking about IPOs is that companies that IPO are companies which are sustainable and which are going to are likely to provide long-term value. And I think, and the other beauty about an IPO, it is 99% true. It's the only thing that you can really control, as in you can't control being bought. So I don't think it's a problem if you think about an IPO. I think the fact that you're thinking you're in for the long term, I think the fact that you think that you're going to build a sustainable standalone business, and that you are in control of your exit for the investors, I think all of that is very, very positive, but also realize it is totally unlikely.
How about more broadly, should entrepreneurs who are pitching you guys talk about exits in the first, because I think it's a sort of a split.
Absolutely.
Absolutely not.
Okay.
Great. Why not?
Let's duke it out.
Yeah. Well, I mean, we had a conversation. Well, I had a conversation one of the 12 today people that I met, and he was talking about exit. You know, and you know, I was sort of saying, wasn't that potentially a competitor? And he goes, yes, that's a great exit. And we all know that you're in for an exit. So as much as an acknowledgement that you know that.
No, we don't.
Okay, I wasn't. Okay, you're saying you don't, or no. You don't want to exit?
No, they don't always know that.
Sorry. Okay. Sorry. So sorry. Yes, an agreement in that to make sure that all entrepreneurs know there has to be an exit. That is why we're putting the money in is essential. But I don't think that. But that's the only reason they need to talk about an exit.
Well, to me, exits are strategic. So I'll give you a perfect example. I started a company called Launch It. It's a newsroom for the world. As soon as I announced the company, I called the two biggest companies I wanted to acquire me because I was going to take away their customers, and I found the big problem that two big companies, had that they couldn't solve because they couldn't disrupt themselves or they weren't willing to do it. So I went into the start of my company, Launch It, with the intent of exiting to those two companies. Now, there's nothing wrong with it because, if anything, I've identified a deficiency in a billion-dollar company's ability to support their customer. The fact that I'm thinking about an exit, I'm thinking about their customers' needs. Now, I may not exit, right? It may not happen. But if you actually can articulate the clarity of a compelling exit because you're actually looking at a company, big company, that can't actually meet the needs of their customer, that's not a bad thing. It's a strategic imperative.
I think the difference in just dealing with and working with a lot of angels versus seed funds, I think you just see a difference. I think most angels want to see a list of exits, who you're going to exit for, how much you're going to grow the business. I think most VCs want to see that you're going to stand alone and grow it to be $1 billion. You're also looking at markets, I think, that might be a little smaller than what we would accept. And you don't want people to raise, like you said, like $500 million. That would dilute you. I'm not sure how you guys are following on. But I think that's really one of the main differences. And when people share their pitches with me and ask for my feedback, you know, you can definitely tell when it's geared to an angel versus geared to a seed.
It is completely unrealistic to think that anyone in this room is going to do anything but exit a company and go other than IPO. And it is completely unrealistic to think you're going to exit a company for more than $100 million. In fact, some of the best exits that you can review that exist are between $10 and $30 million. They're not very large. And they've been done under 5 years' time. So if you're not thinking about an exit, you're not putting people on your advisory board that connect you to the company that's going to exit you, right? Why not do it? On my advisory board, I've got two of the biggest company advisors that know the two companies that I want to exit to.
I love this because, you know, what I love about what you just said is all of the unrealistic things. Let's be very clear. It's unrealistic. You're ever going to get any venture capital. So you may as well just give up and go home. You want to be unrealistic. You want to shoot unrealistic. Do not think in your head that you're building a $100 million company. Be totally unrealistic, because that is what will actually be successful if you're pitching to me. As opposed to it's different for you, obviously.
I don't know who you are. Who are you? We haven't met.
I stayed in the room because I wanted to meet VCs. I wanted to meet every VC here because...
I just wonder who I'm talking to.
Okay. Canada's #1 venture capital fund.
I don't know.
No, that's right. But they put me on the stage because I did know about investing, and I have done some investing.
The biggest difference, by the way, see, this panel, you said are all VCs. I'm not a VC. I'm an angel. VCs don't fund you, frankly, from the seed level. It's infinitesimally small. 90% of all money for seed level funding, 90%, comes from people like me, angels, not VCs. We love VCs because they're going to give the money to scale the business. That's a critical part of the componentry, as long as they don't dilute us out.
You are right, although I am one of those rares that writes $50,000 checks, $150,000 checks, but we are an absolute rarity, so I 100% agree with you.
So let's switch gears for a second here. We all get a lot of people pitching us. We talked about pitches a lot today. Let's talk about what some of those red flags are. I think this audience would probably like to hear about. What are those things that when an entrepreneur is talking about it, right? Turnoffs, right? If you think of some turn-ons too, that's great. But people have been talking today a lot about what do I like to see in an entrepreneur? What do I like to see in a pitch? What are those things that, you know, If you see it there, it's sort of the red flag, something to be avoided.
Well, we are venture investors, and our funds have all been over 100 million euros. So the economics from our standpoint are, if we have typically 25% ownership after several rounds or 30%, and we want to return 2.5 to 3 times the fund to our investors, because that's what they expect from us, that we have to shoot for €1 billion in our case of market cap in a typical fund in order to pay that back with our share ownership. So I'm getting back to the answer. The number one reason that we don't invest in companies is we don't think the market potential is big enough. And at least in our market in Germany, there are many, many of these so-called Mittelstand, it means medium-sized companies in German, that have great technologies, and they tell us, we're going to be the dominant company in the XYZ technology, and we believe them, and they're very credible, but that means they'll have 19.7 million euros of revenue in 5 years and an EBITDA margin of 12.6%. It's highly credible. They'll probably do it, but it's not a venture case. So that's the number one red flag for us, is just the size of the opportunity is too small.
What about those things that's in a sense a categorical thing. You're either that kind of business or you're not, in a way, right? What about sort of things people do wrong, like people come in and, pet peeves you might have, simple things people do that might, in a sense, sort of flag them for, like, I don't know, I want to talk to that guy again.
Well, I think I like coming to this conference because they switched the roles. And one thing that I think we often see that is a red flag are people talk too much about their product. They talk way too much about what it is they're doing, and they talk far too little about the business opportunity and how they're going to get to become a large, interesting company within a reasonable number of years. So if they spend, out of a 45-minute pitch session, 40 minutes talking about the product, it's a big red flag problem. We probably should cut them off like you do here. I mean,
yeah, I definitely agree about too much product, not much about the team. I want really, really simple slides, especially it's a first meeting. The whole goal should be, right, obviously we're going to do diligence if we're going to invest. So just real simple. I want to know about you, especially it's this early stage. I do want to see the product. I want to, I'd rather see a demo than actually, I don't want to see wireframes. I want to actually see a demo of the product. I want to see how you've gotten some traction, show me some product market fit. And I want it easy and simple and nothing ambiguous. I can dig into the details later and really want to get to know the person.
So what's the red flag about that?
What, just more like product. Yeah, too big, convoluted. Literally, you could have 5 slides. Product, market, team. And that's it. And that's all I want to say. And then just like personally, please don't ever do this. I walk into some of these meetings and half the time people think I'm the assistant. I'm not the assistant. You do that, it does not start the meeting well. Look at the name of who you're meeting. If it's a female, she can also invest. So, yeah. Yeah.
She's not laughing. Yeah. So from my vantage point, the only person that matters to you and to me is your customer. It's not market. You can talk market all you want. You can talk about your product all you want. But I'm a behavioralist. And I want to know that you've eaten, slept, dreamed, thought about your customer, that you know what they're thinking before they think about it. I'm going to ask you the really straightforward questions about what they do when they get up in the morning, how they function at their office. What are they doing other than what it is you think they should be doing? And are you changing their behaviors? In the end, it's about someone like you doing something that makes them either more money, more efficient, more career-driven, something. But if you don't have the opportunity to express to me your intimacy, almost that level of intimacy and knowledge about your customer, why are we talking? So much time, it's all this abstract market fit, etc. And unbelievably, how many companies I talk to, founders, when I ask them, give me examples of customers you spend time with, how much analysis have you done? They say, well, that's a good question. And they haven't.
Yeah, I mean, I totally agree with that. I think I do think that's a psychologist, and I think every entrepreneur needs to be a psychologist to really understand who their founders are. For me, for some of the red flags, It's please never say a market is broken. Don't be negative. I want you to have already thought past that. Everything is an opportunity. I don't believe in problems. I only believe in opportunities. Obviously, there's a problem for someone somewhere, but just always focus on opportunities. Don't be negative. I won't remember everything you say, but I want to have a good feeling about you when you leave. That's enough for now.
I got one more thing to
Go ahead.
add, just if I can. It's really remarkable. I want everybody to do this at the same time. I am in control. Great. So when you walk into a meeting with any of us, you better be in control. Because what we don't ask questions about, but what we sense is some founder, some group, some team that really doesn't have a handle on why they're even there talking to us. They're unbelievably unclear. And if I grew up in the internet, I can get anything. And when I hear the basic questions being asked, my first thinking is, you're not in control. And if we're investing in you and you approach us and we get that sense that you're not in control, why would we invest? Would you invest in you?
And in terms of being in control, we are going to try and get you out of control. We're going to try and get you out of control, and we're going to see what you do. I'm going to ask you questions which I don't even necessarily, or I'm going to provoke you because I want to understand, A, how you take control, how you control me, how you will me back, and you pull me down and you feed me the story.
Right.
I think the other thing, sorry, just, I guess there
on.
was a
It's great.
thing.
This is
and
exactly what we
the
wanna
one other thing I think is that's really important, I'm trying to work out, because I'm a seed investor, I'm trying to work out whether you are a visionary or a dreamer. And it's really hard to tell the difference straight away. And the real way you tell the difference is that a dreamer cannot see the obstacles. And when I put obstacles in front of you, if you ignore them, if you push back on them, I think you're a dreamer, not a visionary. I want you to take it, I want you to agree with it, or tell me why I'm wrong, but typically agree with it, turn it round and show how you're going to use that to your advantage.
Well, that's that entrepreneur living on hopium I talk about.
Opium, that's good. All right, so we're going to do a couple more quick questions, and then we're going to open it up for the group to ask of you questions. So real quickly, a couple of things that come up all the time for me when I'm talking to entrepreneurs and they're asking is about founders. Do I need to have a technical co-founder? Do I need to have a business and technical co-founder at the time? Run through it. Do you need to see both in a startup before you invest? Would you invest in something that didn't have it?
I don't need to see a business co-founder. I need to see a technical co-founder.
What do you say, Brian?
Yeah, you need some coder, some tech person who's building it out for you. You can't rely on an outside service. You are in control, right? And if you have an outside service, then it's possible. But if you haven't been able to at least articulate to some other person to join you because you're building a team, a talented CTO, you're probably not somebody I want to invest in.
The only exception, I mean, I was a seed investor in Beyond the Rack. It was two, and also another one called Frank and Oak, two big e-commerce companies, and neither of them had technical co-founders. But e-commerce is one of those things where you're running on a platform that's well known.
Always exceptions, yeah.
Yeah, it depends. If the technology is at all critical to the business, need a technical co-founder, unless it's like an e-commerce company or some other kind of company.
How about
right
a
there.
technical co-founder who doesn't have a business guy?
That's well, yeah, it's fine. They can normally attract someone. I think it's one of the red flags for us though too. One of the big red flags is if someone on the team, especially if it's a little later stage and there's 5 or 10 people, they've never worked together before. They haven't taken someone that was a former coworker. I mean, there should always be someone. It's really a red flag to us if you didn't pull someone that you used to work with for the last 20 years. Like, why can't people get along with you? So.
I have nothing to add.
All right, great. All right, another sticky question you get, and then we'll ask some get questions from the audience. Valuation. Should an entrepreneur who's coming in to talk to you, right, and they don't have a lead yet, should they be telling you what valuation they think they're going out at?
Not necessary. Often they ask us to tell them, or they say to us, we don't want to suggest something, we'd rather you tell us what you think, and that's fine.
People come in and say, here's my valuation, this is the valuation we're going out at?
No. I was in the year 2000. My partners tell jokes about it. A guy came in and he was like a a BCG guy. You know, nothing against BCG guy. I'm a Bain guy. So he came in, and he had a technical co-founder who'd like written 10 lines of code, and he said, I have 6 term sheets. My valuation is 75 million. Are you in or you're out? I said, I feel offended by that, but I haven't been offended lately.
I think the lead should normally set it. I mean, we're normally setting the valuations if they have some kind of expectation. But normally this early, there's stuff that's pretty standard. No,
So
no.
it's okay for entrepreneurs to come without evaluation of the deck and not mention one?
Yep.
Fascinating. You know, it's not about the valuation. It's about the entire journey you take of raising money. Because the process of raising money starts with friends and family. It steps up to what could be a seed, angel, could be pre-seed sometimes. And then it steps up again where the expectation is you're going to scale to a VC, right? That's pretty straightforward. What I would rather you do is go through the journey and make the milestones because you're in control. And you understand that setting a valuation, to me or to any of us here, is an incomplete part of the puzzle. The entire game is pieces of a puzzle, and you have to know how to play that game. Because if you just come in with a number and you don't appreciate the fact that that number unto itself could be wrong, not because you don't understand that that number is wrong, but because the next number that you're expecting on when in time and how much you're going to need for what milestone makes it wrong. And I think there's so much that you need to understand that it's not just about the specific of the valuation. It's the journey of the money that you're raising. And if you have a clear journey understanding of that, that's great. I'll listen to that anytime.
I mean, that you're going to come in, you're going to be talking about a convertible debt, or you're going to be talking about equity.
Never do convertible.
I agree. I don't think it helps anyone. But let's on the assumption you're not talking about convertible debt.
Bad.
Then yeah, I mean the only person it suits is Paul Graham. And then so the only thing I would say is, if you do come in, you talk about valuation, you don't understand what you're talking about, because let me tell you, there's more to value than valuation. I'll tell what's the size of the stock option plan. The bigger it is, the lower the valuation. I say you want a $10 million valuation, okay, there's a 50% stock option pool. So there's so much more to it than the value. And the other thing is, if you come in and say this is the value, it effectively says, I just think you're money. And it's not a good message to send. So I'd recommend you don't talk about valuation. I don't think it wins you any favors.
Yeah, we need to know as angels if you're wild, nuts, crazy, because otherwise we won't start the conversation. We have to have some sense whether or not we're anywhere near the rationale of what a company generally, pre-revenue, by the way, should be thinking about. Because what's the point of wasting our time? So we want to know. And then we can have that discussion about figuring out what that number sort of, kind of could or should be.